Right. Good morning. Good afternoon. Oh, Bob, wet weekend. I don't know what's the situation in Bay Area. It's getting colder from Bay Area perspective, but don't know here if we're going to have rains or not. Better if we can get some rain, that'll be good. But we'll see. Weather has been nice. I think it's get little colder in morning, but morning and evenings. But I think daytime, it's much better. Daytime 75 plus. Not a raining SoCal. Good, yeah. We need rains. We need rains. Hopefully, we'll bring some relief, and we can see some more greenery. It's sad to see some hills, covered in dry grass, brown or yellow grass. Will be good to see those hilltops covered with some green color. All right. How was the week? Exciting, to say the least. A lot of stuff happened, at least in the markets. A little more volatile than usual. And yeah, I had some stuff to share. I tried something new in the market, so do want to share that. Closed a trade on PRU. PRU is what? Prudential Financials. Yeah, financials are now they're reporting results, and I think from a business perspective, the traditional banks are doing good. I'm not sure about the stock, but I think the traditional banks are doing good, especially the banks which had which are stronger on the lending side. Their net interest margin incomes are doing good because of an increase in interest rates. And I think Prudential, I've never traded on Prudential, but this is one of a mid-sized banks, I would say. Oh, it had a nice jump. Prudential. So let's bring up Prudential. So was that a bullish trade, Bob? The one you traded on Prudential? So what a nice swing. Yeah. So hopefully you made some money on PRU. Okay, sold a put. All right. So close the put at a handsome profit. Nice, nice. Yeah, I'm not trading earnings. I mean, I already have some bullish position in I hold XLF, I hold Bank of America in my portfolio. So that I think those are the two big financials. Of course, I do have a fintech. Fintechs are not doing good because of the tech portion of the business. But I think Bank of America, XLF, those are doing good. Okay. Anything else to share? We had this week we had a CPI report out. So I do want to spend some time on CPI report because I want to close the loop on CPI and what do you call the treasury stuff? The IBond stuff that we had discussed in last few meetings. So I do want to talk about that and close a loop because now the new CPI number is coming in. It means what could happen for the new IBonds. So I do want to talk about that a little bit. I bought IBonds. We'll want to talk about that. I discovered a few more things over there. And I also, and I want to be transparent. I talked about treasuries last week. We looked at different duration of treasuries as well. And I made a move to park some cash. So I do want to talk about that. What's my strategy on that? Bob says, thank you for making all the recordings available. Yeah, you're most welcomed. Yeah, I'm trying to do my part. Hopefully those are useful. But please, my humble request is, please come in this session because we can have a little more interactive live discussions. You could use the recording as a refresher and not as your initial go-to material. Jay asks, I have a theory that Thursday big reversal was because of dollar dropping. All asset classes were correlated: gold, oil, stocks, bonds. What do you think? So, I mean, my thought process on what, why the market suddenly swung to the other side was for whatever reason, we thought that when the numbers, when the initial, anyway, we'll talk about it. When the initial CPI came in, we thought, oh, it's going to be so bad. But once you start looking into the component, you might realize that the biggest portion of that increase in the CPI was housing market, which is starting to cool down. And it could have been just algos. Number two, a lot of institutions were already heavily hedged. They had bought a lot of put options prior to this number announcement. So they may be trying to unwind those. Anything could be possible. But those are my thinking around that. Now, why all assets are moving together? Because the interest rates are high. So all the assets are now got correlated, be it bonds, be it stocks, be it gold, and that's what we are seeing. Yeah, James says reversal maybe because of shorts getting out and algos fire the yeah. Sam says I read bonds go up 4+%. IBonds go to 4+%. No, I do want to talk about it. IBonds. Chinta says triggered stops. It was a manipulation. Should be probed. Now, I'm not a big fan of stop loss. That's the reason. One reason I'm not a big fan of stop loss, I don't use that, is correctly in a situation like what happened on Thursday, when the S&P opened 2% down. Your stop losses, if you have had stop losses, they could have got triggered and the market went back up. Not that situation happens often, but yeah, it was a huge reversal, and statistics shows that it happens only once a while. And for me, it was, I would say, a pleasant surprise, because I generally, whatever I need to do on the markets, I will do it like around before 8 a.m. Pacific time, because after that, I start to have my work meetings and all that stuff. I have to start preparing for that. So when the morning, got up, okay, say markets were red, and like I talked earlier, I'm training myself to buy on the red days. So actually I bought some stocks, added to my long stock position. And then, of course, to hedge, I did a negative delta trade on indices. And then, I was done. And then later on, when I looked at it, I'm like, market has completely changed. So yeah, it was a huge swing. And then I was thinking, because the market went up higher, I was thinking I lost a lot of deltas, and I was thinking, should I add more or not? But then I thought, okay, let me give it one more day to see where the market goes before I change any of my hedge positions. So, but end of Friday, it came back down. So net, I think from options perspective, it's been it was a very good week. Can't say the same for the long stock position, but yeah, I mean, I'll continue to add the stocks that I want to buy when the opportunities like these, are presented, when the market is down 2%, NASDAQ is down 3%, 4%. Okay, it's time to bring some cash that we've been holding on the side, open up the watch list and say, okay, which one do we want to buy? And so I bought some this week. So I think most of the long stock position side, I think every week it's only buying. I think last I sold was in August, that too because for cleaning up my portfolio and just do a tax loss harvesting. But most of it has been buys. All right. So I will talk about IBonds because I also ventured into IBonds side or a treasury side. Jay says, I found this site that shows portfolio. I was surprised at Brian Ferroli. Brian Ferroli, they basically Stock Card, actually they're a sponsor of their YouTube channel, and I've not looked at his portfolio, but I'm not surprised that Brian is down 47%. He is one of the typical high growth investor. So in this market, when the growth companies are being crushed, 47% is normal. And many of the stocks that he would own would be down 60%, 70%. So I'm not surprised. Again, it depends on what kind of investor you are and what kind of investor the other person is whom you're trying to follow. If we want to stay with Brian, we have to be comfortable in the drawdowns in our portfolio of around 50%. Okay? Eventually, if we look at the long-term performance of Brian, I mean, he does talk about it in some of his channels. Over 10 years, it's still handsomely still up. But there are been instances where his portfolio would have gone down 40%, and this time it's like 47% in some years. But I think some of the stocks that you own, like Tesla's, is old since it came IPO. So portfolio is volatile. So be careful. I'm a fan of Brian more, and from an education perspective. And today I do have a Twitter thread that I want to share. I mean, he's very open in sharing his learnings. So it's always good to learn from others' mistake. So I do want to, today I do have a Twitter thread from Brian on his investing mistakes and lessons to be learned. But yeah, I'm not surprised because this is what kind of investor he is. So not surprised to know that the portfolio would be down 47%. Again, this is not his real portfolio. I think this is a portfolio they create on Stock Card, who's a sponsor. All right, so yeah, today we want to talk about CPI and then a little bit around Treasury. I made some moves on Treasuries, and rest as usual. We can look at macro and some news, some charts, questions around options. We can talk about that as well. So let's dive into today's session. As always, everything is education. Nothing is financial or tax advice. So let's look at the CPI number to start with. Because this was the reason why we had such a volatile day on Thursday, right? So CPI number came out. We looked at your all urban consumers, CPI-U. I don't know. I mean, there is CPI, CPI core, CPI-U. Difficult to keep track of what each CPI means. But while I was reading through it, I realized what generally we call as a headline CPI is nothing but CPI-U. Okay. So year over year, it came to 8.2%, which was a little more than expectation, right? And the main reason was shelter, which is your home, food and medical care. So these were the largest contributors to the increase in CPI, right? It would have been worse had the energy wouldn't have helped us. So energy index fell 2.1%. But despite that, we saw net year-over increase of 8.2% in overall CPI, which is headline CPI. Now we're talking about core CPI, which is CPI and you take out the food and energy. That rose 0.6% in September, same as what it did in August. And again, the main culprits were shelter, medical care, new vehicles. That was surprising. I think the old vehicles declined, but the new vehicles increased. So the core CPI was 6.6% up year over year. So which is this one. So I think the two numbers, the main headline CPI 8.2%, core CPI 6.6% increase on year over year. Right? So now the reason why markets got spooked when then initially the numbers came out, because it's very, very clear that Fed, the numbers as high as what we saw, it means Fed will continue to hike at 75 basis points, right? For November, as well as December meeting. Earlier, if I recall, reading, earlier the market expectations were November, we will have 75 basis points. December, it will be 50 basis points. But looking at the inflation number, doesn't look like that 50 basis points will be anytime soon, right? So market just got crushed. It was down 2% when the CPI numbers came out. When you look at those headlines of the CPI, algos would have got triggered. I'm not sure any humans will be able to trade it at such a speed. So for sure, algos would have gotten triggered saying, okay, this is the CPI number, boom, this is what we're supposed to do. Sell, 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 sell. S&P is down 2%. And then you start to look at, okay, what happened? Why did the market fell down so much? Why did the inflation came out so much? Okay, shelter was almost 40% of the increase, right? And then we started to observe maybe the housing market is now cooling down, which could, start to show up in the next month inflation report, and then the situation may be better for the next month. All right, let's start buy. So there could be multiple reasons. I'm just trying to get my own guess around what happened, right? Pundits will try to guess it, but no one knows what Mr. Market is going to do. But the numbers perspective, we had what 5.5% surge in S&P. We don't see these big surges anytime, right? So in the history of S&P, it has opened 2% down and closed up 2% only 4 times prior to this week. In the overall history of S&P, which is whatever, maybe more than 100 years old, right? This week was the 5th week. So it was so volatile, right? That you open with down 2% and eventually you close up with more than 2%. Right? So clearly, Mr. Market can't make up his mind. We don't know what's going to happen. And that's how I always think. I don't know what market's going to do. We can't invest or trade based on knowing what's the market going to do. However, there are strategies which are called trend following, which you follow the trend. There are some trend following investors or traders. I am not one of them, but I think those strategies are done well. So I do want to talk about that as well in the end, if time permits. Anyway, coming back to this, we had a very volatile week, and the treasuries 10-year were more than 4%. This is some handsome return, which is free of your state and local taxes. And 2-year hit 4.5%. So it is still inverted, 10-year, 2-year comparison. So if your 2-year is higher than 10-year, that means an inverted yield curve, which is, if there is any indicator which can predict a recession, the most reliable is a yield curve inversion, right? Any other indicators, the reliability is questionable. The one which has come closest to predicting recession is yield curve inversion. And I think in some of the previous videos, we talked about why it is, because of, how the companies start to behave when the interest rate goes higher, and then how it starts to show up in an economy 12 to 18 months down the line, right? So we are seeing this in this yield curve has been inverted for how long now? And no wonder we are seeing 10-year, 2-year, right? That's our yield curve. It is still inverted. So it's inverted in July, right? And it's been in inversion since then. So this is 10-year minus 2-year. So in the normal cases, if you are locking up your money for a longer duration, you generally get higher interest rates. That's a normal trajectory of a yield curve. 10-year is higher than 2-year. But in cases like today, 2-year is paying more than 10-year. So this is where the typical relationship has been inverted. And that is why we call it as a yield curve inversion. Right? So yeah, it entered into inversion since July and still stay inverted. So if we go back and look at how many years, so this is 2018. So let's look at so all right, okay, you could go back and look further on yield curve inversion. Yeah, so we had a yield curve inverted here, and then economy came into recession, and we had a very briefly inversion here. So it's not just the inversion, it also need to pay attention for how long the yield curve stay inverted, because that will determine what the corporates do, which will then determine, the impact of those corporate actions 12 to 18 months down the line. So this one didn't result in the typical, it did result in a recession, but it was a very short-lived recession, which we had it here, right? So yeah, we'll see. So right now, yield curve still stays inverted. 2-year is yielding higher than 10-year, but for those who are savers or who have some extra cash that you want to park, this is a good opportunity for 2-year 4.5%. I've never seen such rates earlier. So from a stocks perspective, I think all the indices were worse than the previous week, except the Dow Jones, and that's because some of the stocks that it holds, those sectors did well. So we will look at these sectors. Otherwise, S&P is down now, what, 1/4? 25, almost 25%. NASDAQ is down 34%. Russell is down 25%. Sector-wise, only sectors which perform relatively better are consumer staples, healthcare, and financials. These are the ones which are generally so-called defensive sectors, defensive stocks. I generally would also see utilities considered defensive, but utilities do not play a defensive role when the interest rates are higher. If the rest of the market is down for any other reason than the interest rate, then utilities does act as a defensive sector. or defensive stock, but a lot of these utilities have a long-term debt, and they are subject to interest rate fluctuations. So that is why we don't see utilities actually acting as a safe haven right now. But of course, the other traditionally defensive sectors like consumer staples, healthcare, financials, they still did better, right? So from a sector-wise, healthcare, consumer staples, they outperformed, whereas the IT, tech, consumer discretionary, as the name suggests, it's a discretionary purchase, right? Tesla is not a must-have. Yeah, we have some money lying around, or we're getting 0% interest rates, or my auto loan is next to nothing. Yeah, we can go and splurge on a new Tesla car. It's a discretionary expense. So in the times of trouble, when consumers start to pull back, these discretionary sector doesn't do good. So not surprised what we see here, right? Yeah, we saw Amazon, Tesla, Meta platforms. It dragged down the overall discretionary sector. So defensive stocks, why do they outperform? Essentially the stocks on consumer staples and healthcare, because many of these companies are pretty stable. If you cannot get, you don't make money on the capital gains, at least these companies provide dividend payments, right? Something that you can get back from the stock market is, hey, you get a dividend payment, you reduce your cost basis while you wait for the markets to recover, right? So essentially, if you would see the big high paying dividend paying companies, which means they do have to have a net profit, they have to have that balance sheet to pay out the dividends, they behave relatively better than the S&P 500 or overall market, right? And way better than the growth sector. So if you're interested, here are some tickers, the ETFs that are so-called low volatility or a defensive stock ETF. Most of them are related to high dividends. So you got iTrust HTV, SPYD. This is consumer staples. Again, both consumer staples, high dividend, healthcare. Those are so-called defensive sectors. I think another one we talked about in some of our previous meetings is SCHD. That used to be my go-to instrument for dividend play. That's also, another option available if you want to play if you want to reduce a little bit volatility in your portfolio. So instead of holding, let's say, SPY or QQQs, which is now down, QQQ is year to date down 35%, right? So what was the other? Let's see, SPLV, SPYD is down 35%. Where did it go? Comparison. There has to be a way to compare. Hold on. Oh, it doesn't allow me to compare to QQQ. Strange. So SPY, what, D? It's down, but it's down less than, year to date, right? Yeah, S&P 500 is down 25%. SPYD is down, but down 15%, right? So you're doing at least 10% better than S&P 500, right? Let's look at how it's SCHD. Yeah, it's down almost 16%. Yeah, so pick up whatever ticker you want to, but these are so-called low volatility. It doesn't mean that these are inverse, but it means it is lesser volatile. This has got lesser beta than the overall market, right? Let's look at HDV. So let's compare with HDV. Now that's down only 6% year to date. Right? Now, in the rising market, these will rise less as compared to the overall market, right? You can't have your cake and eat it too. You can't have the both sides of the market. So in your downturn market, wherever it goes lower slowly and less as compared to market, in the rising market, these tickers will rise slowly as compared to the overall market, right? So overall, the volatility or the change in these ETFs will be less than what you would have in your overall market. So if the quick changes in your portfolio is giving you sleepless nights, you may want to look at some things which are a little more steadier, won't go up 20% and won't fall down 20%. But, it will be, of course, the direction will still be the same as how the overall market is doing, but the magnitude of the change will be a little less. So you could look at some dividend plays. Any one of you already doing this dividends? And if you want to share, maybe what's your favorite ticker to do a dividend play? I mean, 3% dividend yield, 4% dividend yield is great in this market, right? So some portion should, unless you are really super high growth investor, I think some portion should be in little relatively stable ones. Anyone playing dividends? Everyone is high growth. All right, so that's around a little bit on the defensive stocks. What else we saw? Change in central bank's balance sheet. This was an interesting chart in terms of the overall change in 6 monthly change in the central banks, what they hold. So and this was, I think, in one of the Twitter feed, I think I saw it. First you serve the booze, and when the party is in full swing, you abruptly take it away. So boom and bust. This is exactly what we saw 2020 during the COVID time. We all got the booze, we all got our drinks, Kool-Aid, when the central bank started to load up with their balance sheets, and like 6 trillion in 6 months, that changed. And then now the party is over, right? And not just US, I mean, the world across, all central banks follow the same story. And we'll touch upon a little bit on what's happening in England. I mean, they are even in a worse situation. Or at least here, the government and the central bank, they don't always see eye to eye, but they are not backstabbing each other, at least. On the UK and England, it's completely different story, right? There are so funny memes going around in terms of what's happening in England. It's fun to see. So we will touch base upon a little bit to understand what the heck happened in England, how bad the situation was. So at least US is faring better than what's happening in UK. But party is over. And then essentially the message is, guys, the free booze is over. Let's come back to senses. But right now we're all going through the hangover of what we drank during 2020s. So we'll take some time. So looking at the fear and greed index, right now we're still reeling in extreme fear. The gauge is still on the extreme fear side. So whenever there is an extreme fear in the markets, I think it's time to put some cash on cash to work. So overall, if you're looking at a trend, it's still less than 25, which is extreme fear section. So I bought something. Okay, I saw another tweet from John Rotanti. Says some brilliant investors are calling for 10 years of sideways stock market. Right, this is what's typically called the lost decade. I think so Japan is having like lost 2 decades or 3 decades. US stock market also had a lost decade. I forgot, was in 70s or 80s, wherein the markets didn't go anywhere. I mean, if you had bought that S&P 500 at the start of that decade, at the end of a decade, still the same. That didn't go anywhere. So now looking at what's happening in the markets, looks like many pundits are calling for 10-year sideways. So John says, I have zero clue about that. But if hypothetically it plays out, why would you not want a portfolio of highly resilient, profitable, attractively valued dividend growth stocks? So while you wait, you get paid through the dividends. Right? Of course, there are other ways to get paid, especially for us who are interested in options. We can create our own dividend streams, and this is what I've been focused on. But even if you don't do options, yeah, maybe high dividend growth stocks, dividend aristocrats, or maybe some of the tickers that we looked above could be a waiting room while we wait for the Mr. Surgeon Fed to fix the stock market. Of course, I'm kidding. That it's Jerome Powell's duty is not to fix the stock market. He is to look at price stability and employment. But eventually, when market recovers, we can wait in the waiting room while the market is being operated upon. So what I did buys. Markets were right. So I added some long stock in my portfolio. I picked up some Disney, Microsoft, ASML. Disney actually had a reversal of my thesis. So I remember, I think I sold a little bit of a Disney from my portfolio somewhere August, May, April, maybe April, May, June, somewhere that time frame, where I had my concerns around around the CEO and his management style. But then when I read more reports on the performance, I realized my thesis were wrong. My understanding of CEO, it didn't impact let me put it this way, it didn't impact the financial results of the company, right? So I'm like, okay, let's if the thesis has changed, so I do want to continue hold and maintain my position on Disney. Microsoft, no-brainer, is part of my core portfolio. ASML I added, MEL I added, C Limited I added, NVIDIA and TSM. Semis were weak. They were clobbered this week, but I think 10 years down the line, we will have a lot more chips than what we have today. So I'll still bought NVIDIA and TSM. Again, many of them are because I had to put spreads, and then those become in the money. So you close the put spread and pick up the shares at lower cost. Jay says, so Tesla is down 50% in 50 weeks. I wonder how selling put every week 5% OTM would have gone instead of owning the stock. Any good back testing sites? I don't know. I mean, I know CML Wiz is they have a back testing software which is generally being talked about on the options circle. Tasty Works, they also have a back testing software, but I've never used. I think for CML Wiz, 2-3 years ago. Probably I'd used one. Tastyworks I've never used, but they do have, I don't know what they call, look back or something. So they do have a back testing, but I haven't tested this. Right. So what I did this week, like I said, I bought some, and then of course continue to hedge the portfolio. Have a short call spreads on indices and ETFs. That's my go-to. If you look at, I have these always on. I had one for October that close. So NDX, which is the NASDAQ index, have a call spread on that one. You have SPX, I have a call spread on that one. SPY, I have short calls on SPY, right? So RUT. So while on one hand, I'm accumulating some of the stocks that I want to hold in my portfolio, still reduce your delta or overall bullishness in the market by selling calls or call spreads on at an indices level. Like these are some of these, right? So if RUT, which is your small and medium business, if it stays between 1650 and 1750, I mean, we're gonna make some handsome, $1,600 on this, right? Even if it falls down, at least on option, there is no loss. If it goes higher, that's fine. You lose on option side, but your rest of the portfolio still gains, right? So these are my go-to premium selling stuff, covered calls on individual stocks. I think on individual stock, I also have a put spread plus a short call or a covered call. Stuff like Microsoft, I will have a put spread and the covered call. So that's how I own Microsoft this week, because that put spread was in the money. So these are like go-to strategies while we wait for the markets to recover. And I don't control the markets. I don't think anyone controls the market. So we'll wait for it. So yeah, so far this year, out of 71 tickers that I have, 40 reduced the cost basis on 42. The biggest one is on ASML. BlackBerry, it's like $4, $5 stock. We already reduced it by 1.25. Coupang, Disney, GM, Mia. Yeah, we'll wait. So that's a activity for a little bit of this week. My stock buys, and I think this is consistent every week. Is while we wait for the markets to recover, let's sell option premium to reduce the cost basis. Right. Any questions or your thoughts? Other thing I want to talk about is the next one. I had one more new entrant in my portfolio, Mr. Bond. I added Mr. Bond to my, moved some capital from your savings account to an IBond. We spent some time on IBond. So I thought, okay, let me dip my feet in IBond. And the money that I don't need it for next 1 year, and need to keep it in a safe instrument. We don't know how long this market will take to recover, right? If you have to look at what Stanley Druckenmiller has to say, maybe it'll go till 2024. Who knows where it'll go? So there are some specific expenses for which I do want to allocate money. That was lying in a savings account, move that out a little bit out to iBonds. Some house principal repayment. Because it's paying way more than my mortgage is. So I'm like, okay, let's move it there. College fee, can't afford to have my kids' college fee go down 50% or, whatever, 20%, 10%, right? That needs to be in the safe instrument. Okay, let's move it to iBonds or, I don't think there is anything safer than this anyway. So use that. So I did buy iBond. In my account, I went, the only way you can buy is to open an account with Treasury Direct. My God, that website looks like out of 1980s. Believe me. It works, but the interface is so 1980s or 1990s. The whole UI takes you back a few decades. But anyway, so right now we are right at the mid of October. Now the rates will adjust in November. Jay is asking, did you buy bond inside TDA? You can't buy I-bonds in TDA. You can buy treasury bill notes and the 30-year bonds, but I-bonds, your inflation bonds, you can't buy it in TDA. The only place you can buy is on Treasury Direct website. So I bought it on Treasury Direct website. So right now, the bonds that I bought will earn 9.62% for 6 months. So I bought it in October. So now for the next 6 months, I think for October, where my 6 months complete, it will earn 9.62 annualized APY. Now, November, it will be adjusted, right? And now, I want to talk a little bit about adjustment. Even though we are seeing that the inflation is higher, now the CPI numbers came out. Now we can calculate what will be approximate the rate for the I-bonds, that if someone is going to buy the I-bonds in November, what you may expect. So even though the CPI had increased by 8.2%, we looked at the CPI report, at the start of the session. The increase in 6 months has been lesser because there was a lot of relatively the first 6 months we had a much bigger increase. So it increased only by 3.24% in the last 6 months, which is annualized rate of 6.48%. So if you rewind back our discussion on how the interest rates are calculated, there are two components. One is fixed rate, another is inflation adjusted rate. The fixed rate is 0%. Let's assume it will continue to stay 0%. Right? And the inflation rate will be around 6.48%. So I-bonds will probably offer close to 6.48% APY for the next 6 months. So if you buy I-bond today, it will yield you 9.62% for the next 6 months. And after that, it will be 6.48%. Or if you buy any I-bond in November, that will give you 6.48% for the next 6 months, right? But like Steve is saying, all those disclaimers still apply. The tons of disclaimer that we had talked about in our previous sessions. You can't sell it before 1 year. If you sell it before 5 years, so you have to hold it for 1 year, right? If something expense is due in less than 1 year, don't put it in I-bonds. There is no way you can, take it out, or you can sell it before a year. If you sell it before 5 years, you will, so Steve, it is not 3 years yield. You will lose 3 months yield. So if you sell it, say in 18 months, you will be paid interest only for 15 months, right? But I think even that calculation, it is better than what bank is paying me. So I took a plunge. I'm like, okay, I bought some I-bond. So yeah, so for the one which you buy in October, and you still have time, if you're interested, you'll get 9.62, and then any purchases between November 22 and May will earn 6.48. Again, 6.48 is not final, but based on the CPI numbers, this is what the expectation is, right? So whatever you buy, let's say right now, it will earn 9.62 plus 6.48 for a year. I think is much better than any of the bank CDs. So, but there are limits to it. You have a standard limit of only 10K, plus you have a limit of 5K paper bond, plus you can do it for every other member of your family. So considering typical American family, 2 members of parent, 2 kids, you got 4 people. Overall, this becomes what, 60K? Even getting this 5K paper bond is a hassle. So, but if you're ready to go through with that hassle, it becomes 60K. And this week I found another option, which is called a gifting option. Right? You could actually gift to your, significant other, and your significant other can gift to you. So the way it works, you can do another 10K as a gift to any family member. I don't think it's a family member. I think it's any SSN. You can give to anyone else. But there are, you can register that person and say, this is a gift. I have not done through the gift. And then there's where you can go and say gift box. So when you buy this treasury, buy this IBonds, you can say, that I'm buying it for this particular SSN number that you registered as a gift. So the way it works is, it will still, this bonds you bought will stay in your account. You bought the gift for the another person, but you haven't yet sent the gift to that person. So today, if you buy it in October, it will stay in your account and start to earn interest, whatever 9.62% and whatever 6.1, whatever the percentage is. It will start to accrue interest right away. Right? Now, let's say the person that whom you want to gift, you can gift to that person in a year in which that person is not already exhausted its limit. Right? Say I bought IBonds this year, and my spouse bought IBonds this year, right? And I bought IBonds as a gift for my spouse in my account this year. Now, next year, my spouse doesn't buy any IBonds. So next year, I will send the gift to my spouse, because it is still, the limit still applies, right? This every year limit of 10K still applies. But if you buy the 10K as a gift right now, it will start to earn the interest, which is valid right now. And then year down the line, 2 years down the line, whenever you want to gift to that person, you have to make sure that the recipient has not exhausted its limit already. Right? Say if you assume that the 2 years down the line, IBonds are not attractive, maybe that will be a time to pass on the gift to that person. So that's a roundabout way of adding another 10K as a gifting through the gifting process. Again, you can go and read it through the details, but my understanding is that you can still gift it, and there is a gift box, etc. You can mark this as a gift and then again give it to this recipient as a gift. Right? Another thing I think is, if you have a trust, you can buy this under a trust name, or additional 10K under a trust name. But anyway, so the reason is there's a lot of a chatter around this, because everyone has become very interested in buying IBonds, of course. Right? And this year, the IBonds have seen inflows of almost $20 billion from retail investors, which is multiples of what they generally see in any given year. And of course, because the rest of the stock market is not doing good, and if you have a guarantee of for 6 months, you have a guarantee of 9.62% APY return, that has piqued interest of retail investors, including me. We have never talked about IBonds. Bonds were never a fashionable instrument to park any money, unless it's 2022. So yeah, so I did use this opportunity to create an account in Treasury Direct and buy a bond. Again, the money that I parked in the bond was something that I had saved for either the college or a house principal repayment, and I can hold off for 1 year on that one. So that was my thought process. Again, be aware of the liquidity. You can't sell it before 1 year, so don't do it for that. If you sell it before 5 years, you lose 3 months of interest. And other than that, there are no further additional conditions. It is the interest is tax-free at a state and a local level, but you do have to pay federal tax. Always consult our CPA. All right. Other thing I did today, not today, this week, was I bought T-bills. I moved money from my savings account. At least the savings account was still paying 2%, but T-bills pay much more, right? So I deployed some money into 4-week T-bills, 8-week T-bills, and 13-week T-bills. So the investment rate is what I'll get once those are moved, which is 3.3, 3.5, 3.59. It's more than 50% better than bank savings rate. And when I talk about bank savings rate, I'm talking about online banks. I bank with Ally Bank, and they have a decent savings rate for online savings account, in which of course they have a restriction for number of transactions you can do per month, but that gives me around, I think, 2.1 or 2.2% recently. But this is 50 times better than that, and it is liquid. So what my plan is, and I want to share my plan, you can do what you want to do, is to create a ladder so that I have access to liquidity, right? So I bought one 4-week, which I bought in October. I'll get it on 18th. It will expire in, I can redeem it in mid of November. So from simplicity perspective, let's assume I bought it on 1st of October. I just want to explain the concept behind this, why I'm trying to build a ladder so that I can get regular access to liquidity, right? Putting in IBonds means it's done, it's over. You can't touch it for a year. Putting in a CD, same case, right? Unless you're ready to break the CD and pay the penalty. So I was looking to find a way in which I can have access to liquidity plus a better interest rate than the CDs. So what I did was I bought a 4-week, an 8-week, and a 13-week T-bills. Now, to do this, you do have to forecast. Do I need that money next 4 weeks? It's a month, easier to forecast. Month out, do I need this one or not? I'm like, I don't need it for a month, because this one, which I bought here, this tranche will be available for me after 4 weeks, right? So then I can decide in, let's say, in 4 weeks at the end of a month, what do I want to do? If I need that money, hey, because the markets have gone up, Jerome Powell is saying he's going to increase the Fed rate only by 25 basis points. He had a change of heart. Yeah, maybe I'll deploy it in the stock market, right? Add more in the market. If not, my plan is to buy another 13-week of treasury bonds. T-bills, right? So which means from till end of Jan. 4 weeks later, by end of November, this one will be available for me to decide, what do I want to do? If I don't have an expense coming up for which I need this money, if I don't want to add more to the stock market just now, I could buy another 13 weeks. And same is the case with the third one. So every 4 weeks, I have a liquidity available to me. So it means my money, I don't have it tied up for longer term. Every 4 weeks, I'll have the money available to me to make a decision. All right, where do I want to deploy it? And I could end up in getting a little better interest rates than what you get in 4 weeks, right? You get an interest rate for 13 weeks, but you have money coming in after every 4 weeks to make your decision at that point of time. So that's my strategy. I've never done in T-bills, so learned something new this week. And, always a learning opportunity. So it's my exposure into the world of T-bills and the IBonds is my new learning for this week. So yeah, I think overall portfolio, you have a stocks, you have a bonds, you have a CDs, now I have a T-bills in my overall portfolio in terms of from an instruments perspective, right? Cool. Any questions? I do want to look at, because it says 4 weeks, 8 weeks, 13 weeks, 26 weeks, right? So I do want to look at, is there anything available on 17 week? I didn't see it. Maybe it's not coming up for auction right now, but eventually if at every 4 week interval, if I find a T-bill, that'll be wonderful, because then you can build this is generally called ladder strategy. I used to follow with my CDs earlier, but now we can do the same thing with T-bills. Is you create a ladder in which you still buy the longer duration. The longer the duration, you can get a better APY. You can still buy a longer duration, but you still have access to liquidity every at a regular interval, right? So yeah, that's what we did. And if the markets, if I'm more interested in adding a lot more into the markets, yeah, wait for 4 weeks. I'll have money coming out from a T-bill, and then I can deploy it. All right. Any thoughts? Do let me know. Steve said I would go to equity once SPY forward PE is equal to 15. Right now, I don't think it's too far away, Steve. Isn't it around 18 or 16? SPY's PE. Do you recall what's it currently it is? I mean, it had come down. Of course, it used to be 25, 22, but it has come down. I think it's between 15 to 20 right now. But it is still higher than the long-term average. Yeah. It says I would buy SPY at 320. What was a famous line from that BOF analyst that we talked about? Nibble at 3,600, bite at 3,300, and hog at 3,000. So yeah, so I mean, like I am deploying capital on the side, like in buying some of the stocks, but yeah, still holding. I share my portfolio every month, right? So whatever that percentage of cash that I'm holding, I know I'm trying to use this T-bill ladder because now we learned about it. I'm like, why not use it? Why not have little liquidity and at least a better rate than what my banks give me? And I'm sure my bank does the same thing. Any bank who is offering you guarantee will put it in treasuries. That's the only way they can offer you guaranteed return. Now, the bank that is paying me 2% is putting in these T-bills and making 3.5% and giving 2% to me. I'm like, all right, let's cut the middleman, let's cut the banks and go directly to treasury bills. We'll do the same thing. But if you want more than 2%, there's a nation in the world that is now giving 200%. Go and invest in that. Sorry, I don't want to say that. It's not an investment advice, but yeah, this is the nation in which the inflation was like now hit close to 200%, and the bank also hide their interest rates that they're giving you 200%. Should be an easy guess. It's which nation is this? This is the nation with the $1 trillion or maybe $100 trillion bills, something like that. No guesses? No one interested in 200% rate. Not Venezuela, not Argentina. Argentina is not in that bad a shape. I know our inflation is high, but it's not that bad. I think one name which is that's the country. Yep, Zimbabwe. They recently hiked, in June they hiked their interest rate to 200%. But that 200% means nothing because the inflation is 280%. So you still lose money. I mean, in this case, even though T-bills, you still lose money as compared to inflation, right? But it is better than keeping it in the bank. And God forbid, I mean, I have very less only transactional money in my, let's say, Wells Fargo checking account or Wells Fargo high yield savings account, which give me 0.02%. They have no shame in calling that as a high yield savings account, and the yield is 0.02%. This is like 150 times better, not 150%, 150 times better than my Wells Fargo high yield savings account. So why not use T-bills? Now we know about it. Now we are educated about it. Let's put it into action. So I did put this thing into action, but be well aware. If you buy, I think there was a question around TDA. Here's the difference. You can buy these from TDA and you can sell it in the market if you need it, before 4 weeks. Be aware of the change in interest rate, the risk if you try to sell it sooner than the maturity. If you buy it on TD Treasury Direct website, you can't even sell it before 45 days. So if you bought 4 weeks, you can't sell it, because if you bought 8 weeks, then you have to wait for at least 45 days before you can sell it. So there are some restrictions. Be aware of that. All right, so that was my new learning, new addition to my portfolio. Hopefully helpful to you in terms of, maybe you can decide what you want to do. But I thought the latter will work out because it gives me flexibility plus higher interest rate without tying up money for longer duration of time, right? So that was my strategy. Okay, we talked about Brian Feroldi. So I had a Twitter thread from him. So currently the forward PE is 17.39. I think the forward is because I don't know what the current one is. What's the current PE? Anyway, we can get back to that. But I think it's between 15 and 20. Still, Steve, like I said, it's higher than the usual. But we'll see. Yeah, so I'll wait. Slowly. I mean, we still deploy capital and keep a big one on the side. All right, so how do we learn from someone else's mistake? That's the best way, is let's learn from Brian Feroldi's mistake. Like I said, he is a growth investor. I don't know whether he always have been growth investor, but now, at least when I've started looking at him and listening to him and watching his YouTube videos for some analysis on the companies, I do find that he's a growth investor. So what he has to say about dozens of bad stocks that lost me money. Here are 8 unforgettable failures. And the idea is not to gloat saying, hey, he failed and I succeeded. The idea is to learn and find out, what's the reason, what was the core reason behind it, and identify in our own experience. I'm sure we all have had experiences on losing money on one another, but let's be aware of why, what happened. So number 1, IBM. Remember when Warren Buffett bet big on IBM? I did too. I set up a bullish option position on IBM at 200 because it was an iconic brand. It had a Buffett approval, and the Buffett need no introductions, and it's cheap. But IBM did nothing but go down, down, down because its core business was being disrupted by the cloud. Right? I ended up losing a bundle with leverage. So lesson one, avoid leverage. Number two, cheap stocks can get cheaper if the company's moat is disappearing. I think that's very important. Avoid leverage if you don't know how to manage it. And if a stock has fallen down 20%, it can fall down on if your stock is down 50%, it can go down another 50%, right? If it is down 90%, it can still go down another 90%. The main reason, company's moat was disappearing. Now, this could also be a trend reversal for IBM because now they're becoming very active in the cloud. Right? I have not looked at IBM. I don't own IBM in my portfolio, but with the change in the guard on IBM side, with Mr. Arvind Krishna now being the CEO, and he's been brought up from the cloud side, they are now focused a lot more on the cloud. They also divided their business into Kyndryl, which is more on a traditional side, and then focus on the cloud side. Right? So
Vivek.
Yeah.
Lou Gerstner in 1994 got IBM involved in the cloud, so I find this really ridiculous because actually Oracle was the first one, a large name involved in the cloud. And so IBM's been in the cloud for, is that 26 years? Sorry, 1994 is 28 years. So they've done nothing with it. And also Oracle, it wasn't until Amazon got into it, then Microsoft got into it. It's like they did nothing.
Yeah, I mean, Amazon showed the rest of the world that you can rent a cloud space. Right? Probably these people have their own cloud to reduce their own income, but they never realized that there could be business created out of by giving it and renting it out for other enterprises. I mean, Amazon went into cloud. Their main reason why they went into cloud was to save their own cost. And then they realized, come on, we can save so much money. Why can we not have other enterprises save money and create a business out of it? And then Vivek, they created AWS. And now I think everyone is moving towards that as well.
Back in 1994, 93, there was a commercial for IBM. It was, I can't remember what it was, but it was Lou Gerstner introducing IBM into the cloud. It was like they were drawing up a ball, blowing up a balloon, and then it deflating, and then them going in the cloud. So it's kind of like they did nothing with it. Lou Gerstner did something with IBM, but it wasn't with the cloud.
Mm-hmm.
So what I'm saying is I'm very disappointed because I didn't know what was going on back then. It's not until like 25 years later that Amazon and Microsoft are doing stuff with it. It's kind of like,
so maybe IBM came in when the market wasn't ready, and then they did nothing, and then the other players came in and ate their lunch. IBM was big in AI a few years ago with their Watson offering, and then didn't commercialize. Now they shut it down. Maybe we'll see AI commercial solutions coming out in the market 5 years down the line. So sometimes the timing also matters. Maybe it was early in the market. And I don't know, I mean, now what was happening in 1994, but if IBM was in cloud, maybe the market wasn't ready. They had a product, market was skeptical of moving to cloud. Right? All right, so the other thing which I saw, I was looking at, okay, this was Brian's role is, I saw another one, which is Cloudera. Okay, they got killed exactly by the same reason what happened to IBM is Cloudera was a king on your big data on-premise. AWS, Google's, the cloud offering ate Cloudera's lunch. Right? So this moat, if moat disappears, then the cheap stocks can get cheaper. Right? Lesson number 2, 3D systems, DDD. Early 2010s, 3D printing was all the rage. 3D systems was the top dog. First mover, and business and stock were doing incredibly well. What else you need? Business and stock does well. I bought into the hype. Bubble soon burst. Growth started to slow. Stock went down and down. I didn't fully understand the hype cycle, which ended up costing me a bundle. The hype cycle is real. Study it. It's great because the Gartner publishes the hype cycle for every technology. Right? So, and I know it because recently they published the hype cycle for the technology space in which, my employer is in. They didn't, because that space is pretty new. Not many players are in it. So Gartner won't look at it unless, the market starts to have a lot more acceptance. So we were really a little enthused about it, saying now finally Gartner has came up with a hype cycle for our space. And now we can see our company on that hype cycle chart. They didn't even have a hype cycle. So Gartner does publish hype cycle, understand it, and it is real. Recently, we saw hype around SPACs, right, in the recent times. Third mistake, PRAA. And by the way, 3D systems, I do recall that I had, when I had long back, and I wasn't really very active in the market. And I think I did have some 3D printer share, maybe 1,000, but I mean, was very small. But I think I did invest something in some 3D company a while ago. Don't even recall which one was that though. Portfolio recovery, PRAA, is a debt collector. It buys distressed debt for pennies and then collects. It's a founder-run, profitable, high growth. Lots to like, and I thought that the growth was sustainable, but it depended on a continuous supply of a new cheap debt to buy. That was a factor which was beyond management control, right? So debt markets dry up, growth slowed, stock fell hard. So be wary of the companies who rely heavily on outside forces, which is what we are seeing right now with mortgage businesses. Mortgage refinance is down 86% year over year. That's a number I saw this week on CNBC. 86% down year over year in the refinance. Who in right mind would refinance it anyway? If you had bought mortgage anytime before, you're actually paying less. So it's almost down like 86%. So if I'm invested in mortgage refinance companies, yeah, it did great in prior to 2022. What is heavily dependent on interest rates, which business doesn't control. So that's lesson number 3. Okay, I guess number 4. Core Energy is an energy finance company, buys mission critical assets from an energy company and then lease them back. Profits were sent to shareholders as big dividends, no operating risk because they buy the mission critical assets and then lease it back. Huge dividend, good valuation. How can I lose, right? Well, I lost. The business model fell apart when the energy prices itself crashed. The customers who had leased, they couldn't even pay back, the amount that they owed. So profit collapsed, dividend, and stock got crushed. Company financials are only as healthy as their customers. We saw recently Peloton, AT&T. AT&T, if I recall correctly, AT&T had the worst fall in its history because their customers were not able to pay for the expensive phones. So any company's financials are as good as only as its customers. So that is why when you're looking at any S1 or 10K or 10Q, one thing I do want to focus on is customer concentration. If a company has got a customer concentration, then okay, what's the health of that customer? Because that's going to have a direct impact on the company's financials as well. Number 5, Grubhub. Food delivery is in bull market. Grubhub was an early market leader, founder-led, profitable, high-growth network effect moat, or that's what he thought. Turns out the moat wasn't wide at all. Uber Eats and DoorDash stole tons of market share. So Grubhub had to spend heavily on marketing, profits evaporated. I sold at a big loss. So the chart shows that moat really wasn't moat. Not all network effects were created equal. So DoorDash and Uber Eats, they ate its Grubhub's lunch, pun intended here. Next one, Under Armour, high growth, profits, great brand, huge TAM, founder-led, everything was good. I thought it was next Nike, but this is where the management comes into picture. Kevin Plank became hugely distracted by the side projects. And if I recall, they actually bought a wearable company. And their whole plan was that in the clothing, they will have wires which will give real-time feedback. So it's trying to move into the wearable segment, but through clothing, paid a few $100 million. Culture went downhill and the problems start to appear. They chase growth by selling in discount stores. That killed the brand also. So if the moat is brand and management start to dilute it, you should exit. And mostly in these FM, in your sports or in your FMCG, branding is more important. Another one is Tesla. Tesla's brand is right now through Elon. Any disruption in anything bad on the Elon side, that's why it impacts Tesla directly. So if you are a Tesla shareholders, you should know where Elon eats, what he eats, where he sleeps, how long he sleeps, what he does. I'll come back to the comments, but let me just finish this one. Gilead Sciences, another example. It skyrocketed in 2012 after it launched a cure for hepatitis C. Revenue profit is exploding and was trading only for 11 times the earnings. Which I would wonder, is it so cheap, right? High growth profits, very cheap stock. Why it was cheap? Because the revenue wasn't sustainable. Competition entered soon and drove down the prices. The market understood this. I didn't understand it. So this is always a tricky, is your P by E. Right? Price to earnings ratio. Right? Sometimes if it is cheap, it could be cheap for a reason. Sometimes there are, depending on the company's life cycle, it may not be even applicable. So you might still end up buying a high PE in that case, because, hey, you can't judge this company by a PE. And in some cases, you may not want to buy a low PE because the PE is low because for particular reasons. So I find PE as a very tricky measure in my investing decision, because you have to again double click before you can't just take a PE at its face value. So when I look at a PE, I always have to double click on this particular valuation metric, right? RPX Corp, it bought patents and then sells those patents as a subscription service. It's an innovative business model, had a lot of big tech companies as its customer. It was growing fast and a new way to invest in intellectual properties. I bought it soon after the IPO. Now, growth slowed. Why? Because the company already captured the lion's share of market already before it became public. So there is nothing much to do after gone public. So lesson is companies choose when they IPO. So be wary and don't assume that the high growth is here to stay. Again, important factor is when you look at the companies during an IPO time, look at two areas. One is overall TAM, which every company will come and talk about TAM, right? Total addressable market. Hey, our revenue growth is, we just made $2 billion ARR, but our overall TAM is $200 billion. right? So it means not just TAM. The other thing you should look at is, which many companies do not report, so it's difficult number to know, but should do some studies trying to find out what's a SAM. What is a serviceable addressable market, right? Great. Because you would see when the companies talk about what's the overall market size, they will include anything and everything, even which is a peripheral to their business, even which is even remotely connected to their business. What we need to focus on, what's the SAM? And if for the $2 billion company, if the SAM is only $10 billion, then guys, you're already 20% of the overall market. And if this market is attractive enough, we will see a lot more competition coming in and fighting for it. Then I don't want to win that stock. But if the serviceable market is $50 billion, then yeah, you still have a lot of growth potential, right? So that's a lesson from this one. So I hope you could take some of these lessons and apply to your investment thesis. Like I said, PE is the most difficult one to wrap my head around. Not the difficult one, but it's the trickiest one. You just can't take that as a face value. I think others are pretty easy. But yeah, let's learn from someone else's failure. See wherever you have made some of the mistakes in your portfolio, what was the reason? Maybe we can add a few more reasons to this. But this one I do wanted to share. And what a timing. Someone brought up Brian Feroldi today. And I'm like, oh yeah, I do have something to share from his mistakes as well. All right, Sam has a comment on IBM's new vision, network computing, that will drive the next industry growth. Yeah, it looks like then IBM was right on the vision. Market wasn't ready. And when market got ready, IBM had slacked off. Trevor Milton was found guilty. I know SEC sued them. Oh, or was there a judgment already done? Oh, sorry, the trial already done. I read something about it. Okay, so he's looking at 25 years in jail. Good. This is what you should get. I'm happy that the corporate executives, the white collar criminals, are not getting away by just their company is paying fine, gets a jail time. Great. If you run a truck downhill and then claim that, hey, this is a truck which is running through the, whatever, it was a hydrogen or a battery truck, whichever technology was using, it was a clear intent to defraud. So clearly a fraudster. So yeah, should get jail. Okay, let's talk about what's happening across the Atlantic. UK is in a lot of stuff happening on the UK side. Again, we do want to talk about, because some things that happen in UK could have an impact on the global markets. Like 2008, it was US turn. We had issues here in US and we impacted the rest of the markets. UK not as big as US, but some of the, but still not too small to ignore. So we do want to keep an eye on what's happening. And right now, UK was in trouble. If you look at it this week, they fired their so-called finance minister. I don't know what's called in UK. It's like Chancellor of Exchequer. So 38 days into the job and he's out. In my opinion, is basically, I think it was made a scapegoat because it is a government who wanted to do, the prime minister who wanted to do those tax cuts for the rich, for businesses. And then we saw the UK bonds, those gilts, it's called as gilts, the bonds getting crushed. And some of the, because those bonds were getting crushed, some of the pension funds were on verge of bankruptcy. So things could have gone way worse. In UK, so what happened? Bank of England had to come for rescue. So which was like completely, they started buying bonds, which was completely different than what the rest of the central banks in the world are doing is reducing the balance sheet. Bank of England came back and started to buy bonds, because if they had not done it, UK would have been big financial trouble. And that could have also have a cascading effect on the rest, the world economy as well. So eventually this week they rolled back all the tax cuts. I would say this is an egg in the face of a UK government. You just came in, you did something, and now you're rolling it back. Right? So do want to understand what happened, because this does help us in becoming a better investor. All the while we focus on the stocks, look at what's happening in the stock market. But believe me, stock market is smaller, way smaller than what the bond market is. Right? If you look at the relative size of the charts, the one you see in gray, that's the bond market. It's at least minimum 5 times bigger than the overall world stock market. So there was a saying I heard, I think, say the smart money, the institutional investors, the professional investors always keep an eye on bond markets and see what's happening in the bond market, because that market is way bigger and can cause a rout in the financial markets. The retail investors, we keep an eye on the stock market. Right? So, and that's why it is important to understand, because in UK, whatever was happening was all related to the bond market. So if you're not familiar with the world of finance, you may have a trouble distinguishing between some of the key players, right? In the world of investing, size does matter. Institutional investors are the big guns, like pension funds, financial institutions like banks, mutual funds, etc. This is where large bonds are traded. Trades would be worth $500 million to $1 billion trades. So this is what happened in UK, is Bank of England had to step in suddenly after they had declared, like the rest of the central banks have told, we're gonna reduce our balance sheet, we're gonna not add any more assets onto our balance sheet. Bank of England had to do a 360-degree turn and say, okay, we have to buy bonds. Why? Because the pension funds in trouble. Why they were in trouble? Let's understand that. Because pension funds in UK follow a practice called liability-driven investment. So what does pension funds do anyway? And pension funds are the funds wherein the money that has been saved by pension holders is kept. Right? So now, if as a company, as a government entity, as a government department, if you have to pay pension, there's no way you can say, I'm not going to pay it. Because that's your liability to pay that pension. So the pension funds always want to make sure that they can meet their short-term liabilities, and then they invest to to meet their short-term liabilities. They will invest in the safest instruments, right? Like bonds, like T-bills, because those are considered safest. But as we have seen, these T-bills and bonds generally don't pay much, except in 2022. These haven't been a big, good yielding instruments. So what these pension funds also do is they add buying derivatives on top of they're basically on those government bonds. And these derivatives, which will be mostly around options, are leveraged one. So basically, these are the leveraged derivatives. You deploy a pound, and you get an exposure worth of 4 pounds. Right? All that works great until the bonds start to go down. And that's what exactly happened. When the new UK government came in, they announced the tax cuts on wealthy. The rest of the world lost faith. They thought this government has gone crazy. The world is already in inflationary cycle. Everywhere else, the government is cutting down on freebies, cutting down on sending free money. And here is the UK government now saying we're gonna cut down on taxes, we're gonna give pay money to subsidize energy and all that. This is not sustainable. So the government, the UK bonds, gilt bonds, they fell down hard. So and that is why pound became almost equivalent to dollar. Now, when those bonds fell down, and if you have a leveraged position on those who are in options, we know you get those margin calls. So these pension funds start to get a margin calls and then saying, guys, you need to put more collateral if you want to keep your positions open, right? The stuff that you put for $1 and you call it $4 worth of exposure is no longer worth $1. Now it is worth 75 cents. So you need to add more of it so that it becomes $1 again. Overall, your contribution is $1. To meet that demand, pension fund had to sell their bonds and other assets like stocks and corporate bonds. So what that does, it put again more selling pressure. So first of all, the selling pressure on bonds came from outside world, outside of England. And then because the pension funds had a leveraged positions for which they got a collateral calls, they had to sell whatever assets that they own, which is generally safe ones, which are the bonds are the biggest ones. And of course, they hold some stocks. So they had to sell the bonds, which will further push down the bonds. It was become a vicious cycle. So what do? You call Uncle Fed. So they called Uncle Bank of England for an SOS call. Bank of England jumped into the market and started buying bonds so that the prices of bonds go higher. The value of the collateral that these pension funds and put in start to become higher. The pressure of margin calls become a little bit eased out. Right? If that wasn't done, and this is nothing new, right? This has been happening. I mean, this whole leverage-based or your liability-driven investment has been around for 20 years, but bonds haven't done anything for the last 20 years, right? It's only in 2022 we have seen so much action in the bonds that this just blew up. Years of low bond yields, low volatility, this setup had worked well until it didn't work 2 weeks ago. So how much trouble was the industry in? It was estimated that out of 400 pension plans, 2/3 would have been affected by it, which is like 66% of the pension plans were impacted by it. Some comments, we've never seen this before. Really, this happened so quickly. Without intervention from Bank of England, some fear LDI funds would have become insolvent. So that was a crisis that happened on England. I was really intrigued on what the heck suddenly, why they had to go in, what was the reason. And it was an interesting read to know what the heck is happening, how this world works. Again, bond market is way bigger market. And generally, retail investors don't pay any attention to it. But we are a part of the capital market. So invariably, we will get impacted by what's happening in the bond market. So good to keep an eye and get some understanding of how the bond market works. So this was really a surprise that, they get the exposure to derivatives and how leveraged is that exposure is. And what I got also know, it's not just in UK. And this is a standard modus operandi for big players who are dealing in bonds. So now we know it. Let's keep an eye on where the bonds are doing. And now, with my own personal skin in the game with the T-bills and IBonds, I think I will keep some eye on what's happening in the bond market. So that was another thing I wanted to share, a little bit info on the trouble on the England side. All right, here at home, our Fed is also not doing that great. If we run Fed as any company, Jerome Powell should be fired, because Federal Reserve is posting first operating loss in years. So this is looks like Fed also do their P&L statement. I wasn't even aware of it until I saw this thing today morning. So they reported that the earning remittances due to US Treasury of negative $2.9 billion. This is more around optics. Nothing's going to happen. There is no change in the monetary policy, in which, that, hey, Fed has now lost money. Essentially, it means they're not going to remit the money to US Treasury. They're going to remit, $2.9 billion. Essentially, they are negative, means they're not going to give any money back to Treasury for whatever that operation loss is. So Fed won't go bankrupt, and any operation loss means less money remitted to US Treasury. It does not have a meaningful impact on monetary policy. It's just a temporary, because this loss will go away when the Fed will start to cut rates. But the optics doesn't look good, that US Fed is losing money. Just the optics is bad, but no real impact, I guess, other than us losing, or the world losing faith. And then I think that's a much bigger Armageddon, which Bitcoin maximalists, to hope for, is this all money printing, this all Fed is all BS. And one day world will lose faith in US dollar, and will move to something which has got better monetary policy, not controlled by 12 people and all that stuff. But for now, Fed can't go bankrupt. And so this is more an optics issue than anything else. But interesting to see this chart. I don't think I ever saw this chart in my 5 years since I've been trying to dig deeper into the markets. So that was a good read for me. Other thing we saw is US tightened controls on chip technology to China. Nothing surprising here. The rhetoric of a ban on export of certain technologies to China is back. But this time, I think there are, we did the similar thing for Huawei. And now we are doing it for multiple companies that are involved in chip. And again, that's what these semiconductor chips are going to be very, very important for our future. And US is trying to put pressure so that China does not get access to the best technology on the semiconductor side. But this control also bar US citizens or entities from working with Chinese chip makers without explicit approval. So what I read this, it looks like if I am a US citizen, if I'm employed by one of these companies, I have to resign from that company. or I have to give up my US citizenship. But if you are born in US, you have a citizenship by birth, there's no other way. I mean, I don't know how that will play out in the courts, but looks like these, either you have to get an explicit approval, otherwise you are in violation of these of this law around restricting access to chip technology to China. So Taiwan also expressed solidarity with US restrictions on China for obvious reasons, because Taiwan is a home to TSMC, which is the world's leading chip manufacturer. And that's why I like them in my portfolio right now. I mean, right now the stock is beaten down because of this whole rhetoric. What might happen? Who knows if China decides to someday to invade Taiwan? Only reason why the Western world would want to save Taiwan is because of the TSMC. 70%, sorry, 60%, I think between 60 to 70 of the world chips are manufactured by this one company. So if this company, something happens to this, we're all in trouble. The whole of the developed or whole of the computerized, industrialized world is in trouble. Yes, you know, chip is everywhere. It's on my microwave too. Nowadays we have chips even on light bulbs. So if TSMC cannot produce chips or cannot supply chips to US, we'll be in big trouble. That is why Nancy Pelosi went to China. No other reason. And that is why now TSMC is building up plants, semiconductor plants in US, because we do want to have that an ability of developing these chips in-house. So yeah, and if the numbers are right, 90% of the those, you know, the recent smaller size, what do you call them, the high grade chips, you know, the ones that are less than 10 nanometers or 7 nanometers, I think 3 nanometers, 5 nanometers, 90% of those chips are made by TSMC. Right? So NVIDIA, AMD, you know, all these like Broadcom, all they get their chips manufactured by TSMC. If that goes under, all our big companies, you know, the other companies will be impacted. So that's why we do want to you know, make sure that the TSMC stays out of hands of China. So that was one news. Other one caught my eye was Meta and Microsoft partnership. So Microsoft partners with Meta to bring Teams, Office, Windows, and Xbox to virtual reality. So wow, that's how the team setting would be in the VR. Why Microsoft wants to do this? Because Microsoft wants to. Okay, so let's read a statement from Satya Nadella first. We are bringing a Microsoft Teams immersive meeting experience to Meta Quest. So Quest is a Meta Platform's VR headset. In order to give people new ways to connect with each other, you can connect, share, collaborate as though you were together in person. I haven't yet experienced this, so we'll have to figure out how the overall experience looks like. So benefits to Microsoft is they're hedging their own bets on the future of work in AR, VR headsets, right? If what Zuckerberg is trying to do or projecting, if that indeed comes true, that we're gonna have a virtual meetings not through Zoom, because Zoom, you know, eventually it's a square boxes, but we'll move into a way wherein we could virtually be sitting across the table, have that spatial you know, recognition, can look left and look right rather than staring in front of your computer monitor in the square boxes. If that becomes a reality, then Microsoft do want to be part of that. So they had experienced, previously that experimented with it. So Microsoft had invested in something called HoloLens. And I recall seeing the demo of HoloLens, and I think that was the future to go. But what I did know, that the person who was leading HoloLens actually had resigned, and or probably was thrown out. And now Microsoft actually scrapped the plans of for HoloLens 3. I remember seeing some videos of HoloLens. It looks to be pretty cool, but maybe now that project is in jeopardy. Who knows? So it looks like, at least what Satya wants to do, is to align Microsoft as a software and productivity tool provider for VR devices. Maybe that VR device right now is they are tying up with Meta. They could tie up with anyone else, whoever is building the best VR device. Apple, we talked about last week. They already filed a patent with some code name for their own VR device. I'm not sure whether Apple will tie with Microsoft or not, but looks like there will be, the device will be as good as the software that runs, you can access through that. So Microsoft wants to focus more on the software side, and looks like not focus on the manufacturing of the device. So that's why they got interested. How it helps Meta, looking at where the Meta shares are and how the Meta shares have been going down. It's no wonder that Meta is looking for some more, what did I press? Some more reliable partners to in this metaverse journey, right? So Meta shares are down, what, 60%. So they are looking for some reliable partner. They hit 52-week low on what, Thursday? Yeah. So this does give them some ally, and Microsoft is a big ally. Yeah. Number two, so far Facebook has only been a consumer application. Right? Yeah, they have their what's that, Horizon work team or workspace. They never have been able to make any inroads into big enterprise customer. And Microsoft has been in enterprise customer for decades. They know how to sell it to them. They know how to milk enterprise customers. So rather than Meta trying to compete, let's join hands and use Microsoft's prowess in selling to enterprise customers, because Meta or Facebook had failed, and it is not easy to sell to enterprise customers. We have seen that with what happened to Slack. So I think Meta wants to save itself from Microsoft. They don't want to get slacked by Microsoft. So if we are being a partner for it, let's see how this collaboration works out. But I think that's the reason why they want to tie with Microsoft.
What happened to Slack?
Slack was getting killed by Microsoft, and this is what Microsoft does. I mean, and they are in a position to do this. So Slack is a company collaboration software. It's great. I love it. My company uses it. But then that's the one product company. What Microsoft did was they have a Teams. They go to their enterprise company saying, hey, you are using our Windows software, you're using our Office, we'll give you Teams for free. We'll just add the team in the bundle and you get Teams for free. So if I'm an Office subscriber, and voila, I suddenly start to see Teams appearing there, I have to pay zero cost. So while Slack has got what, 21 million users, Microsoft Teams has 75 million. So and then it was extremely difficult for Slack to go and fight this battle with Microsoft, because Microsoft was giving this software for free. Slack started to bleed. And then they got thankful. And that's the reason why they agreed to get acquired by Salesforce, because now Salesforce is a platform company. Now they could offer Slack at a very cheap rate or maybe for free to enterprise customers. So Slack was just got beaten by Microsoft, even though the product is better than Teams, but the business dynamics just didn't work out. So, and Microsoft does this often, right? So if you are competing in enterprise space, and if you're a single product company, Microsoft could copy your software, features, could create a software which may not be as great as what your software, your product is, but they could give it for free. And what happens? Year down the line or after the agreement is done, they just increase the price of the overall bundle, right? And then they make money through that anyway. So it's a great strategy. Microsoft is well entrenched. So, and this is my thinking, right? So let's tie up with Microsoft, because anyway, Meta doesn't have much cloud on the enterprise side and want to find a partner. So maybe work with Microsoft. But the strategy was great for Microsoft. Copy the software, give it for free, and then increase the price of the whole bundle, a year later, and make money through that. I don't know why the antitrust people are not looking at it, but this is a beautiful strategy from Microsoft. Last thing we want to look at is cloud companies. Are back in 2016 valuation. So if we look at the PE, top 10 SaaS cloud multiples as of Friday market close. Snowflake is at 18x, Zoom in for 14x, and overall median is 4.8x, which is less than like 5x. Last time when it was so cheap from a valuation perspective on enterprise value to next 12 months, which is your, consider this as your, I would say, multiple times of your price by sales kind of a stuff, right? So it's like 4.8 times of next 12 months revenue is the valuation. The median market multiple fell below 5x, first time since 2016. So the cloud companies, as a sector overall, individual companies may still be expensive. Snowflake is trading at 18x multiples. It is down from 80x. I recall it used to trade at almost 80x. Agreed, it's a high growth company. Its dollar net retention is the highest in the software space, but still 80x wasn't sustainable. Now it is 18x, but still higher. But overall, the sector on a median side looks to be very cheap, back to 2016 level. Okay. So if we look at this Wisdom Tree Cloud Computing ETF, it's down more than 50% for this year. Right. So we want to, navel onto the cloud computing side. We have turned the clock back to 2016 from a valuation perspective. Right. It's already beaten. That doesn't mean it won't get beaten up further down. You never know what market has to do. But for sure, many of these companies like Amazon's, Google's of the world, there are many companies that have grown their businesses, grown their revenue multiple times since 2016. But what they don't have right now is the tailwind of zero interest rates. What they don't have right now is the tailwinds wherein the market was ready to give them high multiples, right? So that's why this overall the sector is down to 5x multiple. Maybe interesting. We may find some interest in this. Yeah, if you don't want to look at individual companies, there are some ETFs on cloud computing. So this is one of them. So that's a status on cloud. Any thoughts on it? All right, now the last point is around trend investing, right? Or trend following. I don't know, maybe could this be another name for momentum? We basically trade based on what's happening in the market right now. And I think typically this is what many of the retail investors do. I will trade based on where the market is going right now, right? Don't want to look at and see so I'm a little different type of investor. I want to look at a business, do a little more fundamental side, and then use options to start building positions. But there are many who are trend followers, right? They know how to follow, where the market is going, what it might be looking to do in a short term, and then take positions based on that, right? So I just want to spend 5 minutes on this one, and then we'll be done for today. What is trend following? Most simple example is easiest. We just buy the assets that have been going up recently and sell short that has been going down, right? Just follow the trend. Don't fight. You have heard, don't fight the Fed. This says don't fight the trend, right? However, the implementation is a little more complicated. There are a lot of people whom we call as the quants, and then what we call as the algos, that determine the math to figure out, has the trend started or has the trend finished? This one, this one is going down at, let's say if I'm here, if I invested here, how do I know that I'm not investing at the top of the short-term trend? How do I know that I'm not selling it here when the trend is about to reverse? So that's where a lot of quants and algos will come into picture, try to time these or the trends to figure out when to invest. But the whole idea is let's swim with the market. Let's not swim against the market. This is contrary to contrarian approach, right? Contrarians will go, if every market is going this direction, I want to take opposite position. Trend investing is, I'll go with where the market goes. It is reasonable for traditional buy and hold investors to be skeptical that trend following is more than a flash in the pan. And reason is, trend investing didn't have a great performance in the last decade. It didn't do buy and hold that worked the best in the last 1 decade, right? If you cherry pick a starting date as the end of a financial crisis in 2009, the S&P has returned 700%, while the trend index is up only 64%. Right? So while we're talking about it today, maybe whatever worked in past, right, is not a guarantee that will work in future. So if you're looking at, I think I do have some results. So this year, there are some trend investing strategies that have worked way better than S&P 500, right? So for example, Alpha Simplex Managed Futures Strategy Fund is a mutual fund that is up 38% in 2022. There we go. S&P is down 25%. This is up almost 40%. It's a 65% alpha, right? Great. These things didn't work in last 10 years. Maybe the world may not remain the same for the next 10 years. Who knows? Right? So how to invest if you're not a trend follower? If you don't know how to identify when the trend is going to change, and so that you can position yourself accordingly, here are some funds or ETFs. Right? The benchmark itself is up 27% in 2022. Regular investors have taken notice of trend follower status as a go-to place for positive returns during a rough year for both stocks and bonds. I saw one tweet on Bloomberg today morning. 60-40 portfolio, 60% stock, 40% bonds. Annualized year-to-date performance is the worst in last 100 years. Nothing is working this year. You're in stocks, you're in bonds, you're in gold. Nothing had worked. There is no place to hide. And the traditional 60-40 portfolio is the worst performance in last 100 years. So where does some of the investors are going? They're trying to figure out some way to get some positive returns, and looks like some of the strategies of trend following have worked. The dynamic beta fund, whose ticker is DBMF, again, no recommendations. I don't have any positions in any of these, so I want to be clear. But I just read about this, so I want to share. You can do your further study if you are interested in this, right? The dynamic beta fund, whose ticker is DBMF, has seen inflows for 18 straight months, helping the assets jump more than 2,100%. So this fund had only 13 million 18 months ago, and now it's got 870 million. Now everyone is trying to jump into the trend of trend investing. There are other ETFs, Simplify Managed Future Strategy ETF, the Wisdom Tree Managed Future. So everyone has a managed futures strategy. Maybe we should just Google for this and see ETFs are found. And then First Trust Managed Futures Strategy, they've all seen their assets grow this year. Right? So maybe it's worth considering whether this year's standout performance in trend could be a start of another trend. Who knows? Last 10 years, buy and hold had handedly outperformed the trend following. Maybe this year is signifying a start of a new trend, which is trend investing. So yeah, let's see. I don't know. I mean, you find this interesting? Want to do trend following? So there are some mutual funds or some ETF tickers available for you. But as always, do your own study. Like I said, I don't have any positions on this one yet. Sajjan says, buy TQQ on red days and SQQ on green days and sell when profitable. Follow the trends. Yeah, I've decided buy on red days and do your sell your calls or do your delta reduction on green days. Cool. I think that's the last one topic for today, guys. We're done. 2 hours 10 minutes. Feel much better. Didn't stretch it too long, so feel good. Cool. All right, I can hang around for another 10 minutes, 15 minutes to talk about anything else. Any new stuff that you did? So like I said earlier, for me, wading into treasury and bonds was new learning for me. So we'll see how that goes. I think I'm pretty okay with the T-bill stuff, so that money was anyway lying in the bank account. It could very well sit on treasury if it's giving me 50% higher return than what bank is giving. So why not? Any opinion on garlic bulbs? I'm assuming not the stock around garlic, but garlic is healthy. That much I know. Doesn't taste great. You can't go near to someone if someone had a raw garlic. The breath smells horrible. But all I know, especially the big garlic bulbs, it's called what? Elephant garlic. These are very good for your heart. Again, not a medical advice, but this is what I do here. That's the only opinion on garlic bulbs. Gosh, that's a completely, this took me by surprise. Question on garlic. But I'm not a big foodie, so don't ask me for food recommendations, please. I'm not a big foodie. Cool. Any other thing? What's happening on the cyber security front? Like Zscaler is down 60% year to date. I don't know what's happening. I didn't have a chance to look at that, but maybe we'll have to see. I think again, Zscaler is still big. CrowdStrike is still okay. I was talking to one of my friend yesterday, who is a VP in a security company, cyber security, and he was like, companies are giving discounts, like cyber, this not cyber, what do you call it? CrowdStrike. And the companies like CrowdStrike are giving heavy discounts to their customers. I mean, CrowdStrike is one of the leaders. So smaller companies are feeling a lot of pressure. But I think that's because of overall market. I think companies are trying to cut down on any kind of expenses. Cool. All right, no further questions. All good. This was a volatile week, but doesn't matter. I think week over week side is still okay. 1% up or down doesn't matter, but over, I think Thursday was a big swing. So don't get into FOMO. Just for me personally, not big change on the strategy. Right? Still have, if a good stocks fall down, I'll pick a few more, while in parallel, let's continue to reduce the cost basis. We'll wait for markets to come back. Do you think Amazon was able to reduce inventory? I heard that this is what Prime Day 2 wasn't a success. So Pishang, that's what I also read, was that it didn't matter much. This is Prime Day 2, which Amazon had done because they want to reduce inventory and reduction. And I think this is, again, if you look at it, we may be our next inflation number, and I have no crystal ball. But if all these companies are now stuck with huge inventory, what are they going to do? They will have to sell it at discount. So could that put a downward pressure on inflation? Yeah. But we don't know how much would that be. So while right now the whole narrative is around the inflation still continue to go strong, it could just swing into other direction anytime. And that is why I'm not getting out of market, because if it snap back, if we see that inflation is coming down and Fed has to just come and say that, hey, we're gonna pause, or we're gonna increase we're gonna reduce the amount at which we will increase the Fed rate, market is gonna swing in another direction. So, but we saw with Nike, we saw with Target, we're seeing with Amazon. These retailers are now saddled with some inventory which they need to dispose of because they have to make space for the holiday. So maybe we can get some better discounts from them. Kunal, thanks for sharing insights and all. You're most welcome. Yeah, I'm no expert here, so yeah. The fact that I have to come in the morning, it means I have to read something. That's a motivation for me. So thank you for coming here and having the discussions. What's a good site to check Sharpe ratios of hedge funds or ETFs? I have not looked for any, but I'm assuming that each of the hedge or the ETF documentation would provide that information, Jay. But let's try for someone. Let's pick up SPDR's SPY and see. ETF, does it? I'm assuming the documentation of the hedge fund, the ETF should have this information, but I have not looked at it. Let's see. This is fact sheet. I never looked at the fact sheet for SPO because I assume that there is nothing surprising here. Does it show Sharpe ratio? Uh, 3 to 5% dividend yield. Oh, its PE is 16.65. Let's search for. No, it doesn't show. Okay. No, I think maybe let's Google it. Portfolios lab, that one shows up as a first one. It shows Sharpe ratio 0.80. Let's try that. Does it show for anything else? Let's say QQQ. Does it show Sharpe ratio? Oh, this site is nice. See, if you learn something new. Okay, I'll bookmark this site. Oh, it does show, okay, heat map. This Sharpe ratio is 0.95. There we go. Oh, database like a screener. They do have a fund screener, but I don't know if they have. Again, I just visited this one now. Do you have a Sharpe, this asset class category issuer? What's this? No, I think the screener doesn't have Sharpe ratio in it. Let's see, does Finviz show the Sharpe ratio? If Finviz, if sure, then we can build a screener. Let's say Adobe. No, Finviz doesn't have it. Yeah, so I think in the individual side, maybe tools has something, portfolio performance comparison. No. Or maybe I think the first one that came up was, oh, there we go, Sharpe ratio. It has explanation. Does it have a comparison? Maybe, let's say AAPL and add SPY. And let's say TSLA. Okay, how do I find? Oh, no, it doesn't show me Sharpe. Sorry, but maybe I will try to see if something in this portfolio is left. We can find out. No, I have not looked at on this. So yeah, I just Googled. I think these one shows up. This is curvo.eu, some European site. Sorry, not of much help, but I found some good site. So thank you for that question. So looks like there is some interesting information in this site though. I like that site to see, okay, unusual. Yeah, options trades. I don't know if it tells us exactly whether it is a buy or a sell, because that's always a confusion in terms of it's a flow, but we don't. Again, I mean, we could follow, but then what we don't know is what their outlook is, right? They bought a put. Is it because they're bearish, or they're still bullish but want to have just in case kind of a stuff? Right? So that's the stuff you need to understand. What else do they hold in portfolio before you decide on this one? But yeah, it's an information that you can make use of. Volume or this, okay, this not clickable. I can't sort it. Okay, so it's 159 buy put. Okay. Yeah, I mean, I haven't looked at. There is another podcast which I do listen to, if I'm on a walk, which is from Option Insider. They also talk about some block trades on options, but again, this doesn't factor in my investment thesis. Again, that depends from investor to investor. If it works out for you, great. But yeah, I generally don't have much time to look at this one on what others are doing. I think overall, over a longer period of time, things just normalize it. Cool. All right. I guess that's it for today then. Right. Yeah, so next week, do share if anyone of you venture into any of these bonds and T-bills or did anything new. We'll be interested to figure out what else, someone else is doing, what any new things that you guys are trying, and we can learn from each other. So I shared my new ventures this week. Hopefully, let's see if we can learn something from your experiments in the financials market. Cool. All right, guys, thank you everyone, and have a wonderful rest of the weekend. We'll talk again next week. Till then, stay safe, and markets will be what markets do. They'll go up, they'll come down. We don't have to panic. We don't have to become greedy. Just keep your position small. Don't go too big. Doesn't matter how confident you may be about your analysis. Markets are always unpredictable. With that, let's end up that session here. Thanks, everyone. Goodbye.